Now we have non-current liabilities. These are things such as debts expected to be paid or settled after 1 year. Examples include banks loans / notes payable that are longer than 1 year. Lease obligations. So instead of us full out buying a building or a piece of equipment, we could lease it out. But remember, with lease obligations, they're more than 1 year, and we have to eventually pay them the lease payments, and we have to return the asset back to them. So once again, that is a future obligation. Pension and benefit obligations. So pension and benefit obligations, I'm not going to dive into this in too much detail, but essentially in a nutshell, what this is the company has a pension plan set up, which they eventually have to pay out to the retired employees at a future date. Once again, non-current liability. Deferred income tax liabilities. So lease obligations, pension and benefit obligations, and deferred income tax liabilities are out of the scope of this video. If you're actually interested in these topics, I'll be releasing videos in the future for intermediate accounting terms. So I'll talk about these more in those videos. So these are obviously usually accompanied by excessive notes to the financial statement. So I want to build on this right here. This is very important. So even though there's 4 financial statements, there's actually 5 components. The 5th component is that of the notes of the financial statements, which dives into each account in more detail for a company and explains it much more.